Hey everybody, I wanted to talk about 2025 tax brackets. That way we all know what we're going to have to pay next year, right? Hopefully this will help, but it's part of a lot of different little videos about taxation that we'll do this year. So make sure you subscribe to the channel and keep coming back every week. I've got new videos for you. All right, here we go. Let's start with the basics. Standard deduction. Virtually everybody takes standard deductions now because they're so big. We don't itemize as much anymore because we're very limited on our itemized deductions. So, single people, you're going to get your first $15,000 as tax-free income. So, if you only made 30,000, 15 of that's tax-free. The rest of it will be taxed on the following pages. If you're over 65, you get a nice little boost of $2,000. So if you're single and over 65, that's 17,000 you get as an automatic deduction. Married filers get 30. There's no marriage penalty here at all. And then if you're over 65, each of you gets 1,600 additional. So that is a kind of a plus right there. You get a bigger standard deduction if you're both over 65. All right. Now, how does this apply to everything? Well, let's start with the standard income tax bracket for 2025. The first $11,000 is 11,925 is taxed at 10%. We have to remember that these tax brackets are taxed one bucket at a time. If you fall over to the next bucket, you only pay taxes the higher rate on the what fell into that bucket. Okay, so it spills over one bucket at a time. Just because we had 104,000 as a single person doesn't mean everything got taxed at 24%. So we have the same tax rates, nothing changed there, but the buckets got bigger. This is what happens every year. Now, as it stands today, 2026, 12 is going to go to 15, 22 is going to go to 25, 24 is moving to 28. Do we have hope that they're going to extend these? Yeah, most likely they will extend these. That's the speculation, though. What is written in stone is that these tax brackets will change coming up soon for 2026. But the IRS just moves these for inflation purposes. So single taxpayers on the left, joint taxpayers, married couples on the right. You can see it's 11.9 here, 23.8 here, 48 here, 96 here, so forth and so on. Once you reach 11.9, you start filling up the next bucket. And then once you reach 48, you start filling up the next bucket. Okay, got these lines here because almost everybody considers the 10 and 12% tax brackets low taxation. Almost everybody considers 30+% taxation high taxation. The gray area is in the middle. Some people consider the 20s low, some people consider it high. All right, so the cool thing and what makes this very useful is when we add the standard deduction to this. Okay, so here we go. This is what everybody should be looking at. This is what's important. This is what will drive decisions in 2025, whether it's Roth conversions, whether it's choice of putting into pre-tax 401k or Roth 401k. We need to be looking at this version, not the raw tax brackets, because again, almost nobody itemizes. And if you do, it's not going to be that much more than your standard deduction typically. Okay. So for the vast majority of people, we're going to look at this and we're adding a zero tax bracket and we're moving all of these buckets. They all just got way bigger. And now they look a lot more realistic. So now for a single person over 65, if you're making 65,000 or less, you are considered in very low taxation. And for married couples, that's 130,000. Okay. Now, if you're making as a single person over 214.3, you're in the 30+% tax brackets. You want to defer to later dates. Hopefully you will be paying less taxation later. For married couples, if you're over 427,000, defer. Let your heirs pay the taxes. Let somebody else pay the taxes. Because you think about it like this: if you're retired and making over 427,000 a year, your heirs, maybe you got 5 heirs where you're going to split your money into 5 different smaller chunks. And the idea of them all being that successful and paying those kind of tax rates is slim to none for most people's families. So the reality is we need to understand these taxes and know what this stuff means. Again, if you're within this 12% range, you're in very low taxation. We should be okay paying these taxes. We just don't like paying more than we have to. That will also help make decisions on Roth conversions. If a married couple had 100,000 worth of income, go take 30,000 and convert it. There's a lot of situations where that makes sense. Obviously, you need to analyze your own situation, but that's an example of a situation that usually makes sense. Let's choose to pay 12% so we don't have to pay higher percentage anywhere in the future, and we don't have to take a required minimum distribution in the future on that money we converted to Roth. Okay, so this is a very useful chart right here when we add that standard deduction to those tax brackets. This really shows you, especially for the low-income families and retirees, this whole 12% tax bracket realm here is where you want to try to stay to be as efficient as possible. 130 for a married couple tax return and below, and 65 for a single person tax return and below. Then you got the 20s, that's that gray area. Some people are going to consider this high, some people consider it low. Okay. And then the 30s, defer. Don't choose to pay more taxation than you need to. All right, so the next part of this we need to understand is long-term capital gains, qualified dividends. When we look at this chart, we have to understand that they pull out long-term capital gains and qualified dividends from our taxable income, and they tax them on a separate tax scale. So this is where the complications of our tax returns become make people go cross-eyed, a little hard to calculate on your own without computer systems. We used to do it in the good old days, but now we have computers do this work for us. So what a lot of people don't understand is in that old tax bracket, if the previous tax bracket, if you're in the 12% tax bracket, you're paying 0 taxes on your qualified dividends and long-term capital gains. This is the cumulative total of taxable income. Okay, so if you had 80,000 as a married couple of taxable income plus 10,000 in capital gains, you're still under the 96 total. You're only going to pay zero on your long-term capital gains or qualified dividends in my example. But if you had 80,000 regular ordinary income and you had 30,000 qualified dividends or long-term capital gains, some of it will be 0, but then we're going to go over that 96 and the rest of it will be 15%. And then we get to the 200, 250, that's where this net investment income tax comes in. The 3.8 tax gets charged on top of that 15 all the way up to 533 and 600, and that's when we start paying the 23.8, which the capital gains tax is 20 plus that investment surtax. I hope that makes sense. So again, to make this a little more meaningful, we add that standard deduction. So we have that in there because we're automatically going to get that on our tax return. So now that qualified dividend and long-term capital gain bucket gets bigger. If your total income as a married couple, including the long-term capital gains, including the qualified dividends, is less than 129, you're not going to pay any taxes on these gains and dividends. Long-term capital gains, owning something for more than a year. You buy the stock at a low price, you sell it at a high price, that's your gain. Whether it's a rental property, a bond, a stock, that's more than a year is a long-term capital gain Qualified dividends are U.S. stocks that you own 60 days before and after the ex-dividend date. So maybe when you first purchase, you hit at the wrong time, but the rest of the dividends should be good. So U.S. stocks, not in these mutual funds that are buying and selling, because inevitably they're going to turn them into non-qualified dividends and you're going to pay full taxation on that. So we want to make sure we're getting qualified dividends out of our after-tax portfolio so we can get these tax advantage rates, because I'd rather pay 0 when I'm paying 12 on my ordinary taxes, and I'd certainly rather pay 15 than 23% on my ordinary taxes. So very important. These are very tax advantaged. We need to use this properly when designing our portfolio. And this really comes from having the right investments in the right parts of our portfolio. Okay. All right, everybody. I hope that helps. We got lots more tax videos coming up. Very important to understand your personal taxation so you can make sure you're making the right decisions. If I can help in any way, yourinvestmentcounselor.com. I can do a 30-minute free meet and greet over Zoom anytime. And certainly if you're looking for hourly advice, I'm always happy to help there as well. Full classes, we conduct them 3-4 times every single month over Zoom, fpfeaz.org. Our 2025 schedule is rolling out, and we've got lots of new full classes every month, different topic. And certainly give us a call if you need anything immediately from us. Again, subscribe to the channel, forward these to other people. Let us know what you think in the comments section. Thanks again, everybody. Have a great one.